Welcome back to the Daily Crypto Deep Dive. Today, we're going to talk about something that often gets misunderstood when markets turn volatile. We're going to talk about why institutions don't run away from volatility the way retail does, and why, in many cases, they actually lean into it. The headline today is Galaxy Digital, launching a $100 million crypto hedge fund right in the middle of a shaky market. And on the surface, that sounds counterintuitive. Prices have pulled back. Sentiment is fragile. Headlines are cautious. So why would a firm like Galaxy choose now to launch a new fund? To understand that, you have to understand how institutional capital actually works, and how different that mindset is from the way most people experience crypto. Retail investors tend to associate volatility with danger. Big red candles feel like failure. Sharp drawdowns feel like something has gone wrong. And emotionally, that makes sense. Most people come into markets looking for linear progress. Up days feel good. Down days feel personal. But institutions don't look at markets that way. They don't see volatility as a threat by default. They see it as raw material. Volatility is what creates opportunity for hedge funds. Without movement, without dispersion, without assets moving differently from one another, there is nothing to trade. A flat, calm market is actually the hardest environment for an active fund to operate in. When everything is quiet and correlated, you can't express views. You can't hedge effectively. You can't rotate capital efficiently. Volatility is what allows skilled managers to generate returns independent of direction. That's the first key point people miss when they hear Galaxy launches hedge fund during a pullback. They're not betting on a straight line rally. They're betting on movement, dislocation, and inefficiency. Now let's talk about Galaxy itself. Galaxy Digital isn't a tourist in this space. It's not a latecomer chasing trends. It's a firm that's lived through multiple crypto cycles, including the brutal ones. It went through the 2018 crash. It survived the 2022 collapse. It took losses, restructured, adapted, and came out the other side. That experience matters, because it shapes how a firm behaves when markets get uncomfortable. This new fund is not a number-go-up product. It's a long-short hedge fund. That means it's designed to make money when some things go up and other things go down. According to the details that have come out, roughly 30% of the fund will be allocated directly to crypto assets like Bitcoin and Ethereum. The remaining 70% will be invested in equities, specifically financial services and technology companies that are exposed to blockchain, digital assets, and crypto infrastructure. That structure alone tells you a lot about how institutions are thinking right now. They're not going all in on tokens. They're not abandoning crypto either. They're blending exposure. They're spreading risk across layers of the ecosystem. They're positioning for a world where crypto continues to grow, but not in a straight line, and not in isolation from the rest of the financial system. The manager running this fund has been very clear about the logic. The up-only phase of the cycle is likely behind us, at least for now. That doesn't mean crypto is dead. It means the easy money phase, where you buy anything and it goes up, has ended. From here, returns come from selection, structure, and timing. That's exactly where hedge funds thrive. Think about the environment we're in right now. Bitcoin isn't collapsing, but it's not exploding higher either. Ethereum is holding structure, but momentum has cooled. ETF flows are coming out in size. Macro headlines are injecting uncertainty. Some assets are holding better than others. Some narratives are breaking down while others are emerging. That is a perfect environment for long-short strategies. A fund like this can be long Bitcoin while short a crypto-exposed stock that's overvalued. It can be long Ethereum while short a fintech name that's priced for perfection. It can rotate between tokens and equities as liquidity conditions change. It can hedge macro risk. It can take advantage of correlation breakdowns. Retail investors don't have access to those tools. Institutions do. And that's why volatility scares one group and attracts the other. Now zoom out even further. This fund isn't just about Galaxy. It's about what it signals for institutional sentiment more broadly. $100 million doesn't appear out of nowhere. That capital came from family offices, high net worth investors, and institutional allocators who made a conscious decision to deploy money into crypto now. Not at the highs, not when sentiment was euphoric, but during a period of uncertainty. That's important. Because institutional capital tends to be early, not late. Retail buys breakouts. Institutions build positions during discomfort. Over the last few years, we've seen a steady shift in how crypto fits into institutional portfolios. It's no longer treated as an all-or-nothing bet. It's treated as a volatile, asymmetric asset class that requires management. That's why getting an ETF was the first step. Passive exposure, easy access, controlled risk. Now we're seeing the next phase. Active management layered on top. This is crypto maturing. Another point that matters here is diversification. The fact that 70% of this fund is allocated to equities tells you institutions are thinking in terms of systems, not silos. Crypto doesn't exist in a vacuum anymore. It's connected to payments, custody, infrastructure, regulation, cloud computing, and now even AI data centers. Companies that touch crypto don't all move the same way. Some benefit from regulation, some benefit from adoption, some benefit from volatility itself. A hedge fund can exploit those differences. This also tells you something about how institutions view risk right now. They're not comfortable with pure directional exposure. They want optionality. They want flexibility. They want downside protection. They want the ability to change their mind quickly. That's not bearish. That's cautious confidence. And that's a very different signal from institutions are leaving crypto. If institutions were leaving, you wouldn't see new funds launching. You'd see funds closing. You'd see mandates shrinking. You'd see capital returning to cash. Instead, you're seeing money being repositioned into structures that can handle uncertainty. Now let's talk about timing. Why launch this fund now, specifically? Because volatility creates entry points. After a big rally, everything looks expensive. After a pullback, dispersion increases. Some assets get oversold, some get mispriced, some narratives overcorrect. That's when active managers can add value. From Galaxy's perspective, crypto assets have been repriced lower, but the long-term thesis hasn't disappeared. Bitcoin is still scarce. Ethereum is still infrastructure. Stablecoins are still growing. Regulation is clearer than it was 3 years ago. Institutions are still building. The difference is that expectations have been reset, and that's fertile ground for hedge funds. There's also a macro angle here that can't be ignored. Interest rates are no longer going straight up. Liquidity conditions are no longer tightening aggressively. But uncertainty is high. That creates a world where correlations break down. Gold rallies while crypto pauses. Equities move independently of bonds. Some risk assets outperform others. Again, that environment rewards active management. Now compare this to previous cycles. In 2021, almost anyone could make money in crypto. You didn't need sophistication, you needed exposure. In 2022, almost everyone lost money regardless of skill, because correlations went to 1 and liquidity vanished. In 2023 and 2024, we saw recovery driven by selective narratives. In 2025, we've seen rotation, consolidation, and recalibration. The market is growing up, and that's uncomfortable for people who got used to straight-line gains. One of the most important things to understand here is that hedge funds don't need crypto to go to the moon to succeed. They just need it to move. They just need inefficiencies. They just need differences between assets. That's why Galaxy launching this fund is not a bullish headline or a bearish headline. It's a structural headline. It tells you crypto has reached a stage where professional capital believes it can generate consistent returns through management, not speculation. That's a big deal. It also fits perfectly with Galaxy's broader strategy. The firm has been diversifying aggressively. It's moved into data centers. It's expanded its trading business. It's grown its asset management arm. It's built infrastructure. It's not betting on one narrative. It's building optionality. This hedge fund is an extension of that mindset. Galaxy is positioning itself as a bridge between traditional finance and crypto, not just philosophically but operationally. And that's where the next wave of capital comes from. So what does this mean for you as a listener? It doesn't mean you need to become a hedge fund. It doesn't mean you should start shorting things. But it does mean you should rethink how you interpret volatility. When prices move fast, ask who benefits. When markets stabilize after a flush, ask who is accumulating. When institutions launch products during uncertainty, ask what they see that others don't. Volatility doesn't mean the story is broken. It often means the story is entering a new chapter. The crypto market is no longer just about belief. It's about structure. It's about capital flows. It's about risk management. It's about maturity. Galaxy launching a $100 million hedge fund in this environment is not a coincidence. It's a signal that crypto is becoming a space where skill matters more than slogans. And that's not a bad thing, because markets that reward skill are markets that last. That's it for today's deep dive. If you found this useful, drop your thoughts in the comments, share it with someone who thinks volatility means failure, and we'll keep breaking this space down properly. We'll see you at the top.